Imagine it's 2024. You're 34 years old. You live in a mid-sized American city. You have a college degree, maybe a graduate degree. You've been working full-time for over a decade. You've done what you were told. You've climbed the ladder. You've gotten the promotions. You've contributed to your 401k. You've avoided credit card debt mostly. You've tried to be responsible. And yet, you rent an apartment that costs 40% of your take-home pay. You have student loans that won't die. You drive a car with a 5-year payment plan because that's the only way the monthly number made sense. You've been saving for a house down payment for 6 years, but the target keeps moving. Every year, home prices rise faster than your savings account. Your parents, at 34, owned a 3-bedroom house in the suburbs. Your father worked one job. Your mother worked part-time. They had 2 cars, both paid off. They took vacations. They weren't rich. They were middle class. You make more money than they ever did, adjusted for inflation, and you have less. You've read the articles. You've watched the videos. You've heard the advice. 10 money mistakes everyone makes in their 30s. Stop buying coffee. Make a budget. Invest early. Avoid lifestyle creep. You've heard it so many times it sounds like scripture. But here's what nobody tells you. What they call mistakes are not mistakes. They're rational responses to a system that was redesigned deliberately for 50 years to extract wealth from your most productive decade and transfer it upward. You're not failing the system. The system is working exactly as intended, and you are the resource being mined. This isn't theory, it's documented history. And once you see the pattern, you can't unsee it. Let's begin where all financial autopsies must begin, with what people think is happening versus what is actually happening. The popular narrative goes like this. People in their 30s make money mistakes because they're financially illiterate. They spend too much, they save too little, they prioritize the wrong things, they don't understand compound interest. If only they read more books, downloaded more apps, listened to more podcasts, they would be fine. The problem is individual behavior. This narrative is comforting because it implies control. If the problem is your choices, then better choices will fix it. The entire personal finance industry is built on this premise. Budgeting apps, investment courses, debt payoff strategies. All of it assumes that the issue is you, but the data tells a different story. In 1983, the median net worth of an American household headed by someone aged 35 to 44 was approximately $94,000 in today's dollars. By 2022, that number had fallen to approximately $91,000. 40 years of supposed progress, and median wealth for people in their prime earning years has declined. But that's not the real story. The real story is in the composition. In 1983, the majority of that wealth was home equity. People in their 30s owned houses. They had mortgages, yes, but they were building equity. The house was appreciating. The debt was shrinking. Time was on their side. By 2022, the home ownership rate for Americans under 40 had collapsed. Those who did own homes had larger mortgages relative to value. Those who didn't own homes were paying rent that consumed a larger share of income than at any point in recorded history. And instead of building equity, they were building someone else's equity, their landlords. Meanwhile, student debt, which barely existed as a category in 1983, had become a $1.7 trillion anchor wrapped around the necks of anyone who believed the credential promise. So when someone tells you that people in their 30s are making money mistakes, the first question to ask is, compared to what? Compared to a generation that could buy a median home on a median salary with a 10% down payment? Compared to a generation that could attend a public university for the cost of a summer job? Compared to a generation that received employer pensions instead of being told to navigate the stock market themselves? The comparison isn't valid. The game changed, the rules changed, the math changed, and nobody told you. Let's autopsy the first so-called mistake, not buying a house early enough. The advice sounds reasonable. Real estate appreciates. Rent is throwing money away. Get on the property ladder as soon as possible. Your 30s are the critical window. But this advice assumes something that is no longer true for most people. It assumes that housing is affordable relative to income. In 1980, the median home price in the United States was approximately $47,000. The median household income was approximately $21,000. The ratio was roughly 2.2 to 1. A typical family could buy a typical house for a little more than 2 years of gross income. By 2024, the median home price had exceeded $400,000. The median household income was approximately $75,000. The ratio had nearly tripled to 5.3 to 1. But that's the national average. In major metropolitan areas where jobs actually exist, the ratio is worse. In Los Angeles, it exceeds 10 to 1. In San Francisco, it approaches 12 to 1. In New York, a similar story. And this doesn't account for interest rates. In 1980, your parents may have paid a higher interest rate, but they borrowed less. A $47,000 mortgage at 12% over 30 years costs less per month than a $400,000 mortgage at 7%. Do the math. The monthly payment on that 1980 mortgage was approximately $485 in 1980 dollars, or roughly $800 in today's dollars. The monthly payment on a 2024 mortgage at today's prices and rates is approximately $2,700. But here's the critical part. Wages haven't kept pace. The median household income in 1980, adjusted for inflation, was approximately $65,000 in today's dollars. The median household income in 2024 is approximately $75,000, a 15% increase over 44 years. Meanwhile, housing costs increased by nearly 400% in real terms. So when someone tells you that not buying a house in your 30s is a mistake, ask them a simple question. With what money? This isn't a behavioral problem, it's a math problem. And the math is designed to fail. The question you should be asking is why? Why did housing become unaffordable? Was it an accident? Was it population growth? Was it limited supply? Partially. But that's not the full story. The full story involves a deliberate policy choice made over decades to treat housing not as shelter, but as an investment vehicle, a financial asset, a store of wealth for those who already had wealth. After 2008, the Federal Reserve engaged in quantitative easing, buying trillions of dollars in mortgage-backed securities. The stated goal was to stabilize the housing market. The actual effect was to inflate asset prices while wages remained stagnant. Who benefited? Those who already owned assets. Who paid the price? Those who didn't. Every dollar of home price appreciation that enriched existing homeowners was a dollar of additional burden placed on future buyers. This is a zero-sum transfer disguised as economic growth. And it was intentional. The political calculation was simple. Existing homeowners vote. Future homeowners don't. Protecting home values protects the wealth of the voting class. And so policy after policy, from mortgage interest deductions to zoning restrictions to low interest rates, was designed to push prices higher. Your inability to buy a house in your 30s is not a mistake you made. It's a policy outcome. You are experiencing the intended result. Let's examine the second so-called mistake. Carrying student debt into your 30s. The advice is familiar. Pay off your loans aggressively. Don't let debt linger. The interest compounds. You're wasting money. But this advice ignores how we got here. In 1980, the average cost of tuition, fees, and room and board at a public four-year university was approximately $2,500 per year. The federal minimum wage was $3.10 per hour. A student working full-time over the summer and part-time during the school year could cover the entire cost of attendance without borrowing a dollar. By 2024, the average cost at a public four-year university exceeded $27,000 per year. The federal minimum wage was $7.25 per hour. A student working the same hours would cover less than a third of the cost. The gap is filled by debt. But here's what you're not told. This wasn't inevitable. It was a policy choice. State funding for public higher education per student has declined by more than 30% in real terms since 1990. The cost didn't increase because professors got raises. It increased because public funding was withdrawn and students were told to borrow the difference. Meanwhile, federal student loan programs expanded dramatically. The more loans were available, the more universities could charge. The more universities charged, the more loans were needed. A self-reinforcing cycle of credential inflation and debt accumulation. Who benefited? Universities built new administrative buildings. Loan servicers collected fees. The financial industry securitized student debt into investment products. Who paid the price? You. And here's the mechanism that makes it inescapable. Student debt is uniquely non-dischargeable in bankruptcy. This wasn't always the case. Before 1976, student loans could be discharged like any other debt. Congress changed the rules, then changed them again in 1998, then again in 2005. Why? Because dischargeable debt is risky for lenders. Non-dischargeable debt is guaranteed revenue. The student loan system was redesigned not to help students, but to protect creditors. You carry debt into your 30s not because you made a mistake. You carry debt because the system was designed to ensure you would. This is structural, not personal. The third mistake, not investing early enough. The advice is mathematically sound. Compound interest is powerful. A dollar invested at 25 is worth more than a dollar invested at 35. But this advice assumes you have dollars to invest. Remember the math we just reviewed. Housing costs consume 40% of income. Student loan payments consume another 10 to 15%. Transportation, healthcare, food, utilities. By the time you reach the end of the month, the discretionary dollars that would go into a brokerage account simply don't exist for most people. And here's the part that personal finance influencers never mention. The stock market's historical returns are not guaranteed. They are historical. They are also heavily skewed by survivorship bias. You hear about the markets that recovered. You hear about the investments that grew. You don't hear about the Japanese investor who put money into the Nikkei in 1989 and waited 34 years just to break even. You don't hear about the Argentine who saved diligently in pesos. You don't hear about the German in 1923. The advice to invest early assumes a stable currency, a stable political system, and a market that trends upward over your specific timeline. These assumptions have been true in the United States for the past 80 years. They have not been true for most countries for most of history. And even within the United States, the benefits of market participation have been profoundly unequal. The top 10% of households own 89% of all stocks. The bottom 50% own less than 1%. When the market rises, the rich get richer. When the market falls, the rich have the liquidity to buy more. The middle class sells in panic. The poor were never in the game. The stock market is not a wealth-building tool for everyone. It's a wealth concentration tool that sometimes allows a few outsiders in. You're not making a mistake by not investing enough. You're experiencing the reality that the investment returns quoted in personal finance books are not available to people who can't invest. You can't compound what you don't have. The fourth mistake, lifestyle inflation. As your income rises, your spending rises to match. You upgrade your apartment, you buy a nicer car, you eat out more. You're told this is a character flaw, a lack of discipline, a failure of willpower. But consider what lifestyle inflation actually is. It's spending money on goods and services that are more expensive because asset prices have risen. Your parents' apartment in 1985 cost $400 a month. The equivalent apartment today costs $2,000. That's not lifestyle inflation. That's cost of living increase disguised as personal choice. Your parents' health care plan was provided by their employer with minimal contribution. Your employer offers a high deductible plan that requires you to pay thousands before coverage begins. That's not lifestyle inflation. That's cost shifting from corporations to individuals. Your parents didn't pay for childcare because one income was sufficient and one parent stayed home. You pay $1,500 a month for daycare because both incomes are required to maintain middle class status. That's not lifestyle inflation. That's the erosion of the family wage. When people in their 30s spend more than their parents did, most of the increase is not discretionary. It's mandatory. The cost of being middle class has increased faster than wages. The things you must buy to participate in society, housing, healthcare, education, transportation, these are not luxuries, they're prerequisites. The luxury spending that actually exists, the streaming services, the occasional dinner out, the vacation once a year, and these are rounding errors in budgets dominated by structural costs. But the financial advice industry focuses on the rounding errors. Why? Because the structural costs are politically inconvenient. You can't tell people to skip their student loan payment. You can't tell them to not pay rent. You can't tell them to skip health insurance. So instead, you tell them to cancel Netflix. It's a misdirection, and it works. The fifth mechanism, the retirement savings illusion. You're told to maximize your 401k contribution. You're told that your employer matches free money. You're told that tax-advantaged accounts are the path to retirement security. All of this is technically true, but consider the history. Before 1978, most American workers with retirement plans had defined benefit pensions. The employer promised a specific monthly payment in retirement based on years of service and final salary. The risk was on the employer. The worker knew what to expect. Then came the Revenue Act of 1978, which created the 401k. What was originally an obscure tax provision for executive compensation quickly became the default retirement vehicle for all workers. The shift happened fast. In 1980, 62% of private sector workers with retirement coverage had a defined benefit pension. By 2020, that number had fallen to 15%. What replaced it? You. The 401k shifted the risk of retirement saving from the employer to the employee. You now bear the market risk. You bear the longevity risk. You bear the inflation risk. And you're given a menu of investment options, most of which charge fees that compound against you over decades. Who benefited? Employers eliminated pension liabilities from their balance sheets. Financial services companies gained trillions in assets under management. Executives received compensation packages tied to stock buybacks rather than pension obligations. Who paid the price? The worker, who now must navigate markets, fees, and withdrawal strategies alone. The worker who will retire without a guaranteed income. Dependent on the sequence of market returns in the specific years they need to withdraw. You're not making a mistake by not contributing enough to your 401k. You're participating in a system designed to transfer retirement risk from institutions to individuals while extracting fees along the way. The 401k was never designed for you. It was designed for them. The sixth so-called mistake, carrying credit card debt. The advice is simple. Pay off your balance every month. The interest rates are predatory. This is bad debt. True. But consider why credit card debt exists. Consumer credit in its modern form emerged after World War II. It expanded dramatically in the 1970s, when usury laws were effectively eliminated by the Supreme Court's Marquette decision in 1978. Before that case, states capped interest rates. After it, banks could export the interest rate of their home state to customers nationwide. Delaware and South Dakota eliminated their usury caps. The credit card industry moved there. By the 1990s, average credit card interest rates exceeded 18%. By 2024, they exceeded 24%. In any historical context, these are loan shark rates, but they're legal. And the business model depends on you carrying a balance. The credit card industry does not make money from customers who pay in full every month. They call those customers deadbeats. The money comes from revolving debt, late fees, and interest charges. The product is designed to encourage ongoing indebtedness. Consider the minimum payment. Paying the minimum on a $10,000 balance at 24% interest will take 35 years to repay. You will pay over $17,000 in interest alone. The minimum payment is not designed to help you get out of debt. It's designed to maximize interest extraction while keeping you current. Now consider why people carry balances: medical emergencies, car repairs, gaps between jobs, childcare costs. These are not discretionary purchases. They're survival expenses. When income doesn't cover necessary costs, credit fills the gap. The credit card industry calls this convenience. It's not convenience. It's a stopgap for insufficient wages. You carry credit card debt, not because you're irresponsible. You carry it because the system requires you to borrow to participate in basic economic life. That's not a mistake. That's extraction. The seventh mechanism, the healthcare trap. You're told to have an emergency fund, 3 to 6 months of expenses. This is prudent advice, but consider what constitutes an emergency in the United States. 66% of all bankruptcies are tied to medical expenses, not frivolous spending, not poor planning, medical care. The average cost of a 3-day hospital stay exceeds $30,000. A single MRI can cost $2,500. A course of cancer treatment can exceed $100,000. These are not edge cases. These are normal medical events that happen to normal people. And health insurance, even when you have it, often doesn't protect you. High deductible plans require you to pay thousands out of pocket before coverage begins. Network restrictions mean a single out-of-network provider in your surgery can generate a surprise bill for tens of thousands. Prior authorization requirements mean your insurer can deny coverage for treatments your doctor prescribes. The system is not designed to provide health care. It's designed to collect premiums while minimizing payouts. In your 30s, you're statistically likely to start experiencing the health issues that were invisible in your 20s, and you're doing so in a system where a single illness can erase years of savings. The emergency fund advice isn't wrong, but it's incomplete. No reasonable emergency fund can protect you from a system designed to bankrupt you. The mistake isn't failing to save. The mistake is assuming saving could ever be enough. The eighth so-called mistake, not having adequate insurance, life insurance, disability insurance, umbrella policies. You're told these are essential protections, and they are. But consider the economics. Insurance is a profitable industry. This means, by definition, that the premiums collected exceed the claims paid. The insurance company is not betting on your well-being. They're betting against it, using actuarial tables and algorithms to ensure they win. For most people in their 30s, the insurance products sold are not optimized for their protection. They're optimized for the insurer's profit margin. Whole life insurance, for example, combines a death benefit with an investment component. Financial advisors earn high commissions selling these products. The returns for the policyholder are typically inferior to buying term life insurance and investing the difference, but term life insurance pays lower commissions. So guess which product gets recommended? Disability insurance is often inadequate when you need it. The definitions of disability are narrow. The claim process is adversarial. Insurers deny claims, knowing that most people don't have the resources to fight back. You're not making a mistake by being underinsured. You're making a rational calculation that the products available don't actually provide the protection promised at the price charged. The insurance industry knows this. They spend more on marketing than on claim processing. The product is the sale, not the coverage. The ninth mechanism, wage stagnation versus asset inflation. This is the master pattern. The one that explains everything else. From 1948 to 1973, productivity and wages rose together. When workers produced more, they earned more. This was the era of the American middle class, the era your parents lived through. Then something changed. After 1973, productivity continued to rise. Wages did not. Between 1973 and 2024, productivity increased by approximately 150%. Hourly compensation for non-supervisory workers increased by approximately 15%. Where did the difference go? To capital owners, to executives, to shareholders. The economic gains of the past 50 years were not broadly shared. They were concentrated at the top. And the mechanism of that concentration was financial. Interest rates were lowered, asset prices rose. Those who owned assets became wealthier. Those who earned wages fell behind. Your salary in your 30s may be higher than your parents' salary was, but your salary buys less house, less healthcare, less education, less retirement. You're not earning less in nominal terms. You're earning less in purchasing power. And this is not an accident. The policies that produced this outcome were deliberate. Tax cuts that favored capital gains over wages, trade agreements that offshored manufacturing, union laws that weakened collective bargaining, monetary policy that prioritized asset prices over employment. You didn't make a mistake by choosing the wrong career. You were born into a system that had already decided to transfer your productivity to someone else. The 10th so-called mistake, not understanding compound interest. This one is almost comedic. You're told that compound interest is the 8th wonder of the world, that if you just start early and stay consistent, the math will do the work. This is true for those who have capital. But compound interest works in both directions. When you owe debt, the interest compounds against you. Your student loans, your car payments, your credit cards. The math that's supposed to work for you is working against you every day, every month, every year. And here's the part they don't mention. The institutions that lend to you understand compound interest perfectly. That's how they designed the products. The 30-year mortgage, the 10-year student loan, the revolving credit line. These are all compound interest machines working in the opposite direction. You're not failing to understand compound interest. You're experiencing it from the wrong side of the equation. The people telling you to invest don't mention that you need money to invest. The people telling you that time is your friend don't mention that time is also your creditor. The math works. It just doesn't work for you. So where does this leave us? You're in your 30s. You've been told you're making mistakes. That if you just budgeted better, invested smarter, spent less on coffee, you would be financially secure. But now you know the truth. The system was redesigned, starting in the 1970s, to extract wealth from working people and transfer it to capital owners. Housing was financialized, education was debt-financed, pensions were eliminated, healthcare was privatized, wages were suppressed. And all of this was presented as progress. The advice you receive, the 10 mistakes you're supposedly making, is a misdirection. It focuses your attention on individual behavior, so you don't examine systemic design. It tells you to skip the latte, so you don't notice the housing bubble. It tells you to make a budget, so you don't notice the wage stagnation. It tells you to invest early, so you don't notice the concentration of wealth. The personal finance industry is not your friend. It's a complement to the extraction mechanism. It keeps you looking inward while the system operates outward. This is not to say individual choices don't matter. They do. Within a broken system, some choices are better than others, but individual choices cannot overcome structural constraints. You cannot budget your way out of a housing market designed to be unaffordable. You cannot save your way out of a healthcare system designed to bankrupt you. You cannot invest your way out of a wage structure designed to keep you running in place. The historical parallel is clear. In feudal Europe, peasants worked land they could never own. The surplus of their labor was extracted by lords who claimed legal rights over the harvest. The peasants were told their poverty was natural, ordained, inevitable. If they worked harder, prayed more, behaved better, perhaps they would be rewarded in the afterlife. The structure has changed. The extraction hasn't. Today, you work jobs you cannot escape because of debt obligations. The surplus of your labor is extracted by creditors who claim legal rights over your income. You're told your financial struggles are personal, behavioral, correctable. If you budget better, invest smarter, sacrifice more, perhaps you'll be rewarded. In retirement, the language is different. The mechanism is the same. None of this is accidental. None of it is inevitable in the sense of natural law. It's policy, it's design. It's the outcome of specific decisions made by specific people who benefited from those decisions. And it can be changed, but it won't be changed by individual budgeting. It won't be changed by financial literacy courses. It won't be changed by apps and podcasts and self-help books. It will be changed, if it ever is, by people who understand the system, who see the pattern, who refuse the misdirection. This is historical and educational analysis, not financial or investment advice. What you do with this information is up to you. But understand what you're facing. The money mistakes you think you're making are not mistakes. They're rational responses to an irrational system. The guilt you feel is manufactured. The shame is misplaced. The solution you've been sold is part of the problem. Your 30s are not a test you're failing. They're an extraction process you're enduring. The question isn't whether you'll make better choices. The question is whether the system will allow better outcomes, no matter what choices you make. History suggests the answer, but history also changes. Sometimes, when enough people see the pattern, when enough people name the mechanism, when enough people stop blaming themselves for outcomes they didn't design, the pattern is already in motion. The only question is what happens next. This channel exists to examine the systems before they're publicly autopsied, to explain mechanisms, not assign blame, to use history as evidence, not entertainment. Most of the patterns we examine here go unnoticed until they fail. By then, the cost has already been paid by people who never saw it coming. Seeing it coming doesn't stop it, but it changes what's possible. It changes what you're willing to accept. It changes the questions you ask, and sometimes that's enough.